Hello again, class. Today we're going to talk about exchange rates in Chapter 11, and this will be our final chapter that we're going to cover in the course. What exactly is an exchange rate? Well, it's the rate at which one currency is exchanged for another. I'm sure many of you have traveled before, and in order to purchase stuff in the country you're traveling to, you need to give up some of your currency to get some of theirs. And the rate at which you do that is the exchange rate. Now, trade between countries normally requires the exchange of one currency for another. So it's not just when you travel there, but also businesses who buy from other countries. So we're thinking here of exports and imports. There needs to be transactions related currency. So we typically define the exchange rate as the number of units of domestic currency required or needed to give up to purchase 1 unit of foreign currency. So for example, suppose that the exchange rate between Canada and the US is 1.25. So in this case, given our definition, we're saying that it takes 1.25 units of Canadian currency to buy 1 unit of US currency. So in this case, dollars. And so clearly here we can see that the Canadian dollar is valued less than the US dollar because we need 1.25 of our dollars to get 1 of their dollars. So if we were to find the exchange rate as the number of foreign currency required to purchase 1 unit of domestic currency, then the exchange rate would be 0.80 based on this amount, 1.25. How do we get that? Well, we know from here that 1 US dollar is equivalent to 1.25 Canadian dollars. You can think of on a table, you would have 1 US dollar, and what's equivalent to that is a Canadian dollar, and you would have 25 cents also with it, okay? Now, we can just rearrange this. We can divide both sides by 1.25, and if we do that, we will get just a 1 here, and then this will be 1 divided by 1.25. And so I've just switched this around here. So 1 Canadian dollar then would be equal to 1 divided by 1.25 US dollar. And the 1 divided by 1.25 is 0.80, and that's where we're getting this 0.80 from. So in Canada, we would use this definition, and the US would use this definition. Because again, we typically look at the exchange rate in terms of our own country, and we define it as how much of our currency do we need to give up to get the other currency. Now, typically exchange rates are presented in a matrix form like this. So if you go to Bloomberg Markets and look at the cross rates, you'll see a table like this. I pulled this today from their website. And so all they're doing here is presenting the exchange rate in the 2 different definitions. So the definition in the lower triangle here would be consistent with our domestic definition. So what we would have to give up to get 1 US dollar, for example. And if you look in the lower triangle, you'll see that between the US dollar and Canadian dollar, it's 1.3571. And so this value here is saying that 1 US dollar is equal to 1.3571 Canadian dollars. So we would have to give up this amount to get 1 US dollar. And the upper triangle shows the reciprocal, which is just 1 divided by 1.3571. And so up here, if you look for the Canadian dollar and US dollar corresponding pair here, you see that it's 0.73169, and that is just equal to 1 divided by 1.3571. Okay, so the upper triangle defines it as 1 Canadian dollar is equal to 0.7369. So someone in the US would look at this number and say, okay, I would have to only give up 0.7369 of my dollars to get a Canadian dollar. So it's important to define what we mean by an increase or decrease in the exchange rate, because it depends on how it's defined, right? As we just saw on the previous slide. If there's an appreciation of the domestic currency, that we're going to say is a fall in the exchange rate. That means that it would take fewer units of domestic currency to purchase 1 unit of foreign currency, right? So for example, if we remember our definition from the previous slide, we had 1 US dollar equals 1.25 Canadian dollar. So this is saying, as Canadians, we'd have to give up 1.25 of our currency to get 1 unit of the other currency. And so if this amount falls, then that would be an appreciation of our currency because we would have to give up less of ours to get 1 US dollar. And a depreciation would be the other way around. And so if this number increases, that means our currency has depreciated because we have to give up more of ours to get 1 unit of the other currency. Okay, so if this falls, that's an appreciation. And if this increases, that's a depreciation. Okay, so this is based on, again, defining the exchange rate as domestic in terms of foreign. Of course, if we define it the other way around, these arrows would be reversed. So that's why it's best when we talk about the exchange rates and we talk about whether they're appreciating or depreciating, we use those precise words, appreciate or depreciate. Because if you say the exchange rate fell, I'm not sure if you mean depreciation or appreciation because I don't know how you've defined the exchange. Okay, so just be clear on the use of those terms. So let's test your understanding. So assume that a Swedish krona is worth 20 cents Canadian. How much is a Canadian dollar worth in coronas? So what are we given here? We're given information that we have a Swedish krona is worth a fraction of a Canadian dollar. So then we're basically told here that 1 krona is equal to 0.2 Canadian dollar. Okay, so someone in Sweden, a Canadian, then would only have to give up 0.2 of our dollars to get 1 krona. Okay, and so we're asked how much is a Canadian dollar worth in coronas. So if we look here, we want to convert this to a 1, right? So if we divide both sides here by 0.2, we will get that 1 Canadian dollar equals 5 Swedish kronas. Now let's assume 1 Canadian dollar equals 70 Japanese yen. How much is a yen worth in Canadian dollars? So actually you might want to hit pause here, try and think about it, and then I'll come back and give you the answer. So hit pause. Okay, so I'm back. So basically we're told here that 1 Canadian dollar is equal to 70 Japanese yen. Okay, so in order to figure out how much a Japanese yen is worth, we take the reciprocal. So it's going to be 1 over 70 equals $0.014 or 1.4 cents. You can think of this as being written 1 Canadian dollar is equal to 70 yen. And if you think of the money being put on a table, we'd have 1 loonie on the table and then we'd have 70 Japanese yen. So obviously each yen is only worth a small fraction of what a Canadian dollar is. Okay, so if we want to know how much a yen is worth in Canadian dollars, then we take 1 and divide it by 70. And we get 1.4 cents. Now consider the exchange rate E between Canada and the Australian dollar. Okay, now let's assume this is in terms of our definition before, where this exchange rate is defined as how much a Canadian would have to give up of their dollar to get the Australian dollar. So if it was 1.2 today and 1.4 tomorrow, did the Canadian dollar appreciate or depreciate? Okay, so hit pause to think about it. Okay, I'm back. So since we are defining E in terms of the foreign currency the Canadian dollar can purchase, so we are defining this again as, so this 1.2 means that a Canadian would have to give up $1.2 to get 1 Australian dollar. That's yesterday, and then today we would have to give up 1.4. So obviously we have to give up more of our currency between this period to get 1 Australian dollar. Then of course then our currency, the Canadian dollar, has depreciated. Okay, so now we're going to talk about this concept called purchasing power parity. So this is a theory that suggests, and think of it as a benchmark. We're not going to always think that it's really true in the real world, but it's a benchmark. So it's a theory that suggests exchange rates will change so as to equate the purchasing power of each currency. In other words, the exchange rate is equal to relative price levels. Think of shopping on Amazon. If there's the exact same product on the US site and the Canadian site, then the only difference in those prices should be due to the exchange rate. So if you exchange your money, you should be paying the same price. That's the idea. And of course, in the real world, it doesn't always hold. So the idea is we could also think of this in terms of the overall price level, not just a particular good. So here we're thinking of the price level, and we're going to define the price level in Canada as PC and in Europe as PE. Okay? And then E is going to be the Canadian dollar price of euros. Again, it's going to be how much euros we would have to give up to get how much Canadian dollars we would have to give up to get a euro. And so the theory of purchasing power parity would predict that the price level in Canada would equal just the exchange rate times the price level in Europe. Okay, now this of course only makes sense for tradable goods. we wouldn't expect such a thing to hold for haircuts. And we're also assuming here that there would be perfect information so everyone would know about the different prices, and there wouldn't be any transaction costs, and there wouldn't be any costs associated with shipping and no duties. And this really makes sense in terms of the stock market, and it is exactly what you would expect. So a stock in Apple is a stock in Apple. It doesn't make a difference. So these are traded on different stock exchanges. So it could be traded on the New York Stock Exchange and the TSX. And so there should not be any difference in the price after you account for transaction costs. Well, let's assume there are no transaction costs. If there were no transaction cost and perfect information so everyone knew where the stocks were selling and their prices, the zero transaction costs, then you wouldn't expect there to be any difference in the price of those stocks after you convert for the exchange rate. Because if there was, you could make an instant profit by buying it on one exchange and then selling it on the other. So if this doesn't hold, you can make a quick profit risk-free, and that's actually what we would call arbitrage. So there would be arbitrage opportunities and you would be able to make a profit. And in fact, there's actually arbitrage departments of investment banks that would look for these sorts of things. And I think nowadays it would only exist in the time frame of a millisecond or something like that, because everything's so sophisticated and computerized. So you could have a program trading where you have a program just constantly looking for any differences where there could be a profit. Now, because of this arbitrage, it would actually make this hold, because suppose that the price on the US exchange for Apple stock is lower after you account for the exchange rate in Canada. Well, then there'd be an increase in the demand for that stock on the New York stock market, which would drive up its price until this relationship would hold again. So arbitrage would result in this thing holding. But again, if there's things like shipping costs or zero transaction costs or some issues with people actually knowing about where the stocks are and the prices, then you wouldn't expect it to hold fully because you have to account for those other costs. But as a theory or a benchmark, this would hold given these certain situations. So it's just a useful idea to think about as a benchmark. So let's look at an example. Here we're just going to look at a particular product, not a price level, just to get the idea. So suppose the price of a t-shirt in Canada is $22 and the exact same t-shirt is for sale in Europe at 15 euro. So if that's the case, then the exchange rate should just be the ratio of the price in Canada divided by the price in Europe. And so the exchange rate then should be equal to 22 divided by 15, which is 1.46. Okay, and so that would suggest that 1 euro is equivalent to 1.46 Canadian dollars. So as a Canadian, we would have to give up 1.46 of our currency to get 1 euro. So in fact, if we actually do that, we can multiply both sides of this by 15, all right? And then we would see that we would need $22 to get 15 euro. And so then we could buy the shirt in Europe for 15 euros, or instead use that $22 in Canada to buy the shirt. Okay? And so again, just think about what happens if this were not to hold. Well, if this didn't hold, let's suppose that we don't have to give up as much of our currency. Suppose it was just 1 for 1. Well, then I could take my 15 Canadian dollars and then buy the shirt in Europe for 15 euros, and then I could bring it back to Canada and sell it for $22 and make a profit. Well, that would increase the demand for the t-shirt in Europe, which would drive up its price and alter this exchange rate. Okay, so that's the main idea. So the supply and demand will change to make this equality hold, given that we assume no transaction costs, perfect information, and all that other stuff we just talked. And again, this term arbitrage just simply means buying a commodity in a market where the price is low and immediately selling it in another market where the price is higher. And so you can make a very quick, risk-free return. So there are obviously very little arbitrage opportunities in the context of the stock market, but there could be some in terms of goods sold in different countries because of differences in information, transaction costs, and other things. But if we had a situation like the stock market where we could generally think that those things would hold, then we would expect arbitrage to result in this thing here holding, and then we would have this thing called purchasing power parity. Of course, purchasing power parity doesn't hold generally because of the following reasons. I've touched on some of these before. So many services like haircuts are not traded internationally, of course. There's also transportation and insurance costs. There's tariffs and other trade restrictions. But there's particular preferences by consumers. There's the effect on the value of currencies of trade and financial assets. So all of these things will come in to make it such that the purchasing power parity doesn't generally hold. But however, it's a very useful benchmark to know. Now let's talk about exchange rate systems. So a flexible exchange rate is where the exchange rate is determined by market forces of supply and demand and not interfered with by government actions. A fixed exchange rate is an exchange rate that is pegged by the government and therefore prevented from rising or falling. A managed exchange rate is a mix of fixed and flexible strategies. The degree of fluctuation is managed by the central bank, and that's in order to stabilize the rate. And this is typically what's used in most countries, including Canada. And although this is generally called a dirty float. I guess dirty because we're thinking of government intervention as being dirty instead of... Although the central bank in Canada doesn't intervene extensively in the foreign exchange market, it will do so if there's a particular urgency to do so. On a particular day, there might be some event that's causing the exchange rate to go a lot in either direction, so they might get involved then. But for the most part, they don't have an idea of what the exchange rate should be and make any attempts to fix it at a certain level. So let's look at a foreign exchange market. So we're going to use a supply and demand framework, and so we're going to look at the quantity of Canadian dollars on the horizontal axis and the price for Canadian dollars in pangos on the vertical axis. And this particular example, we're talking about a fictitious currency in a foreign country called pango. So this is the price for a Canadian dollar in pango. So this is how much we would need to give up of our currency in terms of the other currency. So in this case, it's the price for the Canadian dollar in pango. So it's how many pangos you would need to buy a Canadian dollar. So you have to keep that in mind. And so in this space, we're going to say that the demand curve for Canadian dollars is downward sloping. Okay. And we can think of the reason for this to be downward sloping is due to a number of reasons. So for example, the demand for the Canadian dollar will come from different sources. So if there's foreigners who want to buy Canadian exports or who travel to Canada, they will increase the demand for the Canadian dollar. And another determinant of demand is foreigners who want to purchase Canadian investments. So if someone in the US wants to buy a Canadian T-bill, for example, they'll need to sell their US dollars and buy Canadian dollars. Also, people who receive gifts or income or gifts or transfers from abroad, that will increase the demand for the Canadian dollars. And there's also currency speculators and arbitrageurs in the market. We're obviously going to not be focusing on that, but on the first few here. So in terms of the supply of the Canadian dollars, it's going to be upward sloping in this space. So if we want to think about the reason why it's upward sloping, we can think about, well, what if the price of Canadian dollars in the foreign currency is higher? Okay, so in this case, if this is increasing, that means our currency, the Canadian dollars, would be appreciating because you would need more of the foreign currency to get ours. Okay, and that's the same thing in the diagram we just looked at. So if that's the case, then we would be more likely to buy from other countries because we have a strong dollar. And so it would be cheaper for us to buy goods in, say, the United States. So that's why we have that the supply curve is upward sloping. Supply is related to people purchasing goods from abroad. So, for example, Canadians buy currency with Canadian dollars. Would buy foreign currency with Canadian dollars. So if we want to buy something in another country, we have to give up our Canadian dollars and get for foreign currency. So increases in the supply of Canadian dollars in the international money market will increase the supply, and when the dollar appreciates, the effective prices of Canadian imports would decrease, and so then total imports would rise overall. Again, when we have a strong dollar, we like to shop, for example, more in the US because we can get more. So that's the idea. So we have the demand and supply of the Canadian dollar, and so their interaction will determine an exchange rate. Okay, so here in this example, the supply and demand intersect at ER1, so that would be the exchange rates that's determined in the market. And so of course in the real world, on the foreign exchange market, this is changing by the millisecond. So you could think of maybe chasing a moving target. So the exchange rate is moving up and down all the time because the demand and supply curves are shifting. Okay, again, demand comes from foreigners, which mainly in the form of exports. People who want to buy our stuff, they need our currency. Supply comes from Canadians, which are imports. When we sell our Canadian dollars on the market to buy foreign currency, to buy goods from another country. And so the exchange rate, or the equilibrium exchange rate, is where the quantity demanded equals the quantity supplied. So again, the demand for currency is determined by different things. So in these cases here, we would shift the demand curve for the Canadian dollars if any of these change. So we would represent that with a shift. So for example, the level of foreign incomes, if we're thinking of the United States, if they are in a boom period and their incomes increase, they're likely going to, import more stuff from us. Many people might buy more maple syrup, for example. So we would represent that with a shift to the right in the demand for the Canadian currency. The price of Canadian products relative to the price of foreign products will also play a role. If our goods are cheaper because of greater efficiencies, then there's more of a demand for our goods, and so that would result in an increase in the demand for the Canadian dollar. Foreign tastes play a role. If there's a trend for, say, Niagara ice wine and maple syrup and things like that Canadian exports, then that would result in an increase in the demand, or a shift in the demand curve for the Canadian dollar. Comparative interest rates are very important. If the return on, say, a government security like a T-bill is higher in Canada than in the US, and they both have equal risk, then large pension funds or mutual funds that park large sums of money would be more interested in getting that higher rate. And in order to buy our securities, they need to convert their money into Canadian dollars. So that would also increase the demand for Canadian dollars. And this tends to happen sometimes if the Bank of Canada increases the overnight rate, you will see that day likely a bump up or an appreciation in our dollar because of these foreign funds being attracted to Canada. So what happens in the foreign exchange market with an increase in demand? So we would illustrate it as follows. So suppose we have our demand curve here, D1, and our supply curve here. Initially, the exchange rate would be ER1. Now, if the demand curve shifts to the right, the new equilibrium then will be right here at ER2, okay? At the old exchange rate, we would have a shortage, because at the old exchange rate, the supply would be at Q1, but the quantity demanded would be over here at something above Q2. So this would represent a shortage, and when we have a shortage, there's a tendency for the price of whatever we're looking at in a market, here the exchange rate, would increase, and we would get to the new equilibrium. Okay, so in this case, an increase in the demand, or a shift to the right in the demand curve, would cause the currency to appreciate, because the way we're measuring it here on the vertical axis is how much foreign currency is needed to buy a Canadian dollar. So if this increases, that means they need more foreign currency. So if a country needs to give up more of their currency to get ours, our currency has appreciated. So this is an overall summary here on the effects of currency fluctuations. So if exports fall, so people don't want to buy as much from us, that would tend to hurt commodity producers. So tourism would be down, foreign investment would be less. And so in this case, so it's important to be clear with this table. So if our currency appreciates, then we expect that exports would tend to fall. And that's because it's more expensive for foreigners to buy our goods and services. So we're going to have less of them buy commodities that we tend to export. Tourism would be down. We would be selling less, not just commodities, but goods and services. And it's also possible that foreigners would also invest less financial capital. On the other hand, imports would tend to rise, right? Because our currency is stronger, we can buy more from other countries, so we're going to tend to import more. So we would have more Canadians shopping in the US, for example, more foreign cars sold here, more Canadians investing abroad. We would want to maybe buy more US investments. And then if we look at when the Canadian dollar depreciates, we're just going to get the opposite of the above. If our currency depreciates, it's cheaper for people to buy our goods and services. And so that will help commodity producers. We could get more tourism, etc. And then we would also have a fall in imports for the opposite reasons of why they would rise when the currency appreciates. Again, if our currency is not strong, it's depreciated or devalued, then it costs us more to buy stuff abroad. So if we have an increase in exports, then that would shift our aggregate demand curve to the right. So if you remember, net exports is part of the aggregate demand. Remember, it equals C plus I plus G plus X minus imports. So if exports increase but imports stay the same, then we have a shift to the right in the aggregate demand curve. In fact, actually, if our currency would depreciate, we would expect more exports and less imports. So that whole term, net exports, will increase, and we would have a shift to the right in the aggregate demand curve. And so that would tend to perhaps increase the price level, and it would increase our overall real GDP. In terms of a increase in the supply of currency, so this is the foreign exchange market. If the supply curve shifts to the right, that will lead to a depreciation in the Canadian dollar. Okay? If it were to stay here at the old exchange rate, we would have a surplus, and we know in markets if there's a surplus, the price will tend to fall, and it'll fall to the new equilibrium. Fixed exchange rate. So there are some arguments for having a fixed exchange rate rather than a flexible exchange rates, because it would add certainty to international trade. Think of an exporter and they're selling a big ticket item, maybe they're selling an airplane or something like that. Well, they agree on a price now, but the airplane may not be finished, may not be built for another few years. So the exchange rate could move in different directions over that period of time and result in significant differences in what the profit would be from the sale of that. A lot of firms will enter into different types of financial derivatives to mitigate or hedge this risk. So there's lots of ways they can do that with futures contracts and that sort of thing. We're not going to discuss that in this course. But if there was a fixed exchange rate, then we would know for certain what the value or the exchange would be. So firms would be able to estimate exactly how much profit they would make from selling something abroad if it takes quite a long time to finish that. So you would have less instability in import and export industries. This would discourage currency speculation, which sometimes can make the foreign exchange market more volatile, and it would also appeal to people who equate the exchange rate with national prestige, although that's not really an economic argument, so I wouldn't put too much weight with that. So let's think about what would happen if we want to fix the exchange rate. So suppose we are fixing the exchange rate at this level here, ERF, F is for fixed, okay? And suppose initially we're here in equilibrium at D1 and S. Now suppose there's an increase in the demand for the Canadian dollar. So in that case, there will be upward pressure on the exchange rate. We would go up to the new equilibrium. That's where the market would want to go. But at this fixed exchange rate, we would have a shortage of Canadian dollars. So in order to prevent the exchange rate from increasing and keeping it fixed, the Bank of Canada would need to make sure that this supply this shortage is accommodated. So, and that's no problem because they can create money and they can just go out and use that created Canadian currency to buy the foreign currency to prevent this from increasing. Okay, so that's how the Bank of Canada would keep the exchange rate fixed. So in the case of an increase in demand, we would have a shortage. The Bank of Canada would have to accommodate that shortage with new Canadian dollars. And so it would do that and keep the exchange rate fixed. Now, the problem is if we had say a decrease in demand, okay, we could end up having a bit of an issue, as we'll see in a moment. So an increase in the demand then, as we saw, would result in an undervalued dollar and inexpensive Canadian goods. At a fixed rate, more dollars are demanded, which would create a shortage. And to maintain normal trade, the Bank of Canada must provide more dollars. So in order to maintain trading at that fixed exchange rate level. And so it would end up having to increase the money supply. Like I said, they would need to create money in order to buy the foreign currency in order to prevent the exchange rate from increasing. And that could potentially lead to inflation. And so eventually Canadian goods would become more expensive, and then that would reduce the demand for dollars. Now, it becomes more keeping an exchange rate fixed becomes more problematic if the market wants to go below what the fixed rate is. So, for example, in this diagram, similar to before, we're at an initial fixed exchange rate. So here we're at D1 and S, and at QS. Now, if the demand for Canadian dollars shifts to the left, the new equilibrium is down here. So the market will want to go towards this point here at ER2. And at this initial fixed exchange rate, then we would have a surplus of Canadian dollars. So what's going on here is that we have people selling. A lot of people are selling the Canadian dollars because they want to convert it into foreign currency. So there's an oversupply of Canadian dollars on the market. And under normal circumstances, the exchange rate would fall. So in order to keep it fixed, the Bank of Canada would need to buy this surplus of Canadian dollars in order to keep it at this fixed rate. Well, how will they do that? What are they going to buy the Canadian dollars with? Well, they need to buy it with foreign currency, but they only have a certain amount of foreign currency. So if this shift in the left in demand is persistent and is continuing to happen, it's possible that they will run out of foreign exchange to be able to trade for the Canadian dollars, and then the currency will eventually then collapse to the new value. And in that case, you would have a large devaluation potentially of the currency. So that's an issue with the keeping the exchange rate fixed above the market equilibrium. The other way around is fine because the government can always print Canadian dollars. However, the money supply would increase. That could potentially impact inflation, and it would get into the way of some of their other policy options. So a decrease in demand would result in an overvalued dollar, causing a surplus on the world market, and the only way to keep that exchange rate fixed would be for the Bank of Canada to buy Canadian currency with foreign exchange reserves, but the amount that they have might be insufficient to keep the exchange rate fixed, and the foreign exchange reserves could be depleted, and it would no longer be able to keep it artificially above the equilibrium value. Some other choices for the government to take would be to reduce imports through tariffs or quotas, so they could impact the exchange rate through that measure. And some of the other protectionist type things we learned before, like they could increase foreign exchange controls if they have them. They could negotiate voluntary trade restrictions, or wouldn't be the smartest thing to do, but create a recession in Canada, because then we would be importing less, and that would help offset that decrease in demand. Or just devalue the currency, which is what would happen if they ran out of foreign exchange reserves. So now we're going to talk about the balance of payments, the balance of international payments. So this is an accounting of the international buying and selling of the Canadian dollar. And in a sense, the term is a misnomer because the accounting is more like an income statement than a balance sheet. We'll see what one looks like in a moment. So imports of goods will create a demand from Canadians for foreign currencies, if we want to buy something from another country, we need to sell our Canadian dollars on the foreign exchange market and buy the foreign currency. And exports do the opposite. They produce a supply of foreign currencies. So traditionally, Canada has had, until recent years, a positive balance of trade, meaning we tended to export more to the rest of the world than we have import. With the onset of a world recession, Canadian exports fell off considerably, and in 2015, Canada achieved a record trade deficit of $46 billion, compared with a record surplus of $63 billion a decade earlier. Part of this is related to oil. We export oil. The price of oil has fallen substantially compared to back in, say, 2008. So this is an overview of the balance of payments. This is an older example for 2002, but the numbers, we're just getting an understanding of this. So for the current, there's two components, the current account and the capital. The current account contains transactions related to trade. Okay, so here we're looking at merchandise exports, we're looking at service exports, and then we have the imports and merchandise and service imports. And so we subtract off the imports and we're adding the exports. So think of money that's coming in, we have a plus sign. Money that's leaving, we have a negative sign. So the overall trade balance in 2002 was 49.4. Okay, so in this case, we've sold more to the rest of the world than we bought from the rest of the world. We also include in the current account a capital service account. Here we're including things like net investment income. Okay, and so in this case, it is negative. So this is net investment income. So we're looking at people who have investment income abroad or foreigners with investment income here, and then we're netting it out. And so the current account balance would then be 23.2. So we're going to take this and subtract that off and end up with 23.2. Now, if we look at the capital account contains things like foreign investment. Okay, so this here is the net change in Canadian investment abroad. Okay, so when we invest abroad, we're thinking it as a negative, so it's money leaving. In this case, it was negative 81.8. And in terms of foreign investment in Canada, we think of that as a positive. And so in this year, it was 68.5. So the capital account balance in this case would end up being negative 13.3. And now we look at this thing called the official financing account. This contains changes in reserves. So these are reserves held by the Bank of Canada. And then we make up the difference with a statistical discrepancy. And then the official financing balance will be 9.9, and so then the whole thing will balance out. So after we do this stuff here, the balance of payment should net out to always being equal to 0. So let's go into a little more detail with that. So the current account is the subcategory of the balance of payments that shows the income or expenditure related to exports and imports. The current account section of the balance sheet shows the movement of Canadian and foreign currencies as a result of the buying and selling of goods and services internationally. And then we also include in here the flows of incomes between Canada and the rest of the world. And in the capital account, we are talking about the movement of foreign currencies, but as a result of the buying and selling of assets internationally. And this type of selling represents a change in the ownership of assets. So this could come about from either portfolio investment, which is if you buy a stock or bond. If I were to buy a foreign share in Apple or something like that, that would be considered portfolio investment. But it also considers the purchase of an actual asset, such as a piece of real estate or a whole company in another country. And that's considered direct investment. So if I purchase a building to start a business in the US, that would be considered a negative on the balance in the capital account, and it would represent financial currencies leaving Canadian. It's going to be the movement out of Canada of currencies because the money is being invested in the other country. So that's the capital account. Now, the changes in official reserves account just shows the effect of the Bank of Canada's buying and selling of foreign currency on the flow of Canadian dollars. So again, the whole point of the balance of payments is to track all of the changes in Canadian and foreign currencies. So the Bank of Canada does some buying and selling of foreign and Canadian currencies on the foreign exchange market, so we want to include those as well. So the amount here will be equal in value and opposite in sign to the surplus or deficit noted in the balance of payments from the first two, the capital and the current account. Okay, a negative change in official reserves indicates that the Bank of Canada sold Canadian dollars, which would be creating an outflow by buying foreign currency, and a positive change in official reserve indicates that the Bank of Canada bought Canadian dollars, which would create an inflow by selling foreign currency. So for example, if the balance in the current account was larger than the balance in the capital account, the whole net would be positive. So maybe we can think of we exported a lot of goods, and so there was a lot of foreign currency that was accumulated by the Bank of Canada, and so then that would be exactly offset with a negative change in official reserve, so that it would balance out to zero. So here's another example for 2015. Here we have the current account. We have the exports of goods and services, that's 625. We have foreign factor income from abroad, okay? And so this is foreign factor income, so people who are foreigners that have income from abroad. And then this is the transfers received from abroad. So this would be related to the demand for Canadian dollars, okay? Because for each of these, it would result in people wanting to sell foreign currency and buy Canadian currency. On the other hand, imports would be the opposite. That's an increase in the supply of Canadian dollars. People would want to be selling their Canadian dollars to buy foreign currency. And then, so that would be, in this case in 2015, that was 671. So the balance of trade would be the difference between exports and imports, and that is negative 46. Now, factor income paid abroad, so this is money leaving the country, was 105. Net foreign factor income then is the difference between the 91 and 105, so that's negative 14. And then transfers paid abroad, if we net that out with transfers received from abroad, we would get negative 3. So in this example, the overall balance on the current account is negative 63. Okay, so we can think of there's a lot of, we've sold more to the rest of the world than we bought from the rest of the world, so this is a net outflow, you can think. But on the capital account, we have foreign investment in Canada of 258. The Canadian investment abroad here would be 190. So if we net that out, the net foreign investment overall would be a positive 68. And so the balance on the capital account would be 68, okay? And then we have a statistical discrepancy, and this is just to make up for, these values are generally estimated. They're estimated fairly well, but there is some little, there's some things here and there that they might miss. And so here the statistical discrepancy is 6. And so overall, the balance here is a positive 11. So this is the current plus the capital account plus the statistical discrepancy. So in this case, we can think of there's an overall inflow, or, we benefited. So if there's an overall inflow, then we must have accumulated foreign exchange reserves. And so that would be offset by the official settlements account. Okay. So a balance of payments surplus means that overall foreigners were buying more Canadian currency than Canadians were buying foreign currencies. Okay. So the result is that the country, by the way of the Bank of Canada, then must have acquired $11 billion in foreign reserves during the year. So then in return, the Bank of Canada issued $11 billion in Canadian dollars to buy those reserves. Remember, the Bank of Canada can always print more. So in this case, then that it'll balance out because of this official reserve. So what if there was a balance of payments deficit? So that would be the opposite. So it would mean that the Bank of Canada would lose foreign reserves and will acquire more of our own dollars. And again, as we saw earlier, this could prevent a problem because we can only buy so much, we can only buy so much of Canadian dollars with foreign reserves until we run out. Okay, these could eventually become totally depleted. So let's talk a little bit more about payment balances and imbalances. So basically with this balance of payments, we're using a double entry bookkeeping system. And this means that any transaction will lead to both a credit and an equal value debit. Okay, so the balance of payments must therefore always balance. The term balance of payments deficit and balance of payments surplus must refer then to only the balance on some part of the payment accounts, not the entire thing, okay? Because the entire thing should balance to zero. The term makes no sense if they are applied to the overall balance payments. So a deficit in any one part of the account implies an offsetting surplus in the rest of the accounts. So we often hear about balance of payments, deficits, and surplus, but what do the speakers actually mean? Well, a balance of payment deficits often refers to a situation where the central bank is a net seller of foreign exchange reserves. In this case, the current end capital account would, when combined, be in a deficit position. So you could just think generally, if we bought more from the rest of the world than we sold to the rest of the world, just ignoring the capital account, then we're going to have depleted foreign exchange reserves. If we sell more to the rest of the world than we buy, then we're going to accumulate foreign exchange reserves, right? And that's where the benefit comes from having all of these exports. But note that in this case, as always, the balance of payments is actually in balance, okay? Because of, the central bank does not change its holding of foreign currency reserves, the current account and the capital account must sum to zero. So again, anything that occurs in one account, capital or the current account, is offset by the opposite happening in the other account. Let's think about an example. So if the current account increases by 100, the capital account must decrease by 100. Why? The fact that an entry in the current account is offset by an entry in the capital and financial account creates the mathematical identity. So the current account then is equal to the negative of the capital account plus the official settlements plus the statistical discrepancy. So suppose a country has a trade deficit. This means that it bought more from the rest of the world than it sold to the rest of the world. Well, how would we pay for that? How would we be able to buy more from the rest of the world than we sold to the rest of the world? Well, how do we pay for this? Well, we would have to at some point have borrowed money from other countries. And so whenever a country experiences a trade deficit, this will result in a foreign financial assets entering the country. And so when that happens, that'll be recorded on the capital account, and the amount would be the exact opposite or offsetting amount as the trade deficit. So it would be positive on the capital and negative on the current account. Okay, so again, just think about it. We have a total GDP, we have a total income in the country. How could we have bought more from the rest of the world than they sold to us? Well, the only way that could possibly happen is if we borrowed money from the rest of the world, and so then that would show up on the capital account as a foreign investment, so money would be coming in. Okay, so that concludes the lecture for today. I will just now go through one of our in-class exercises. Okay, so suppose that the international demand and supply of Canadian dollars in billions are shown in table 1110 below. This represents the total market for Canadian dollars, that is, no transfer, speculation, or arbitrage. So in part A, we're asked to calculate and fill in the total demand and total supply columns of the table. Okay, so how do we do that? Well, for each exchange rate, we're just going to add these items here. So exports, foreign factor income, and foreign investment all represent demand for Canadian dollars, while imports and then foreign factor income paid abroad and then Canadian investment made abroad represent the supply of Canadian. So we're just going to add these up. So if we do that, we will get the completed table as indicated here. Now it says, suppose that Canada is operating under a flexible exchange rate. Okay, what is the equilibrium value of the Canadian dollar? Okay, well, how do we find that? Well, we're going to look where the total demand for Canadian dollars is equal to the total supply. So we're going to look here at these two columns, and if we look hard enough, we'll see that the equilibrium exchange rate will be 0.98 because that is where the total demand equals the total supply. Okay, so the equilibrium value of the Canadian dollar is 0.98. Now it's asking what is the value of its balance of trade. So if we look at the exchange rate 0.98, we have exports indicated here and our imports are indicated here. And so the balance of trade then is equal to exports minus imports. And so here it's equal to 12. Next, it's asking what is its current account balance. So if you remember, the current account includes the exports and imports and the factor income. So it's going to include both of these items here. So the current account balance then will be 112 plus 70 minus, 113 plus 70 minus, and we're going to look here, 101 plus 67. And so that will equal, this should be 101, and the answer here will be 15. Okay, and now we're asked what the capital account balance is. Well, at the exchange rate 0.98, the foreign investment in Canada is 145, and then we're going to subtract the foreign or Canadian investment abroad, which is 160, and that then will equal negative 15. So what is the overall balance of payments? Well, in this case, the overall balance will be 328 minus 328, which is equal to 0. Now it says, suppose that Canada fixes its exchange rate against the US dollar at a value of 1 Canadian dollar equals 0.96 American. If that's the case, what is the value of its balance of trade? Well, at that exchange rate, the balance of trade will equal 114, which is exports, minus the imports, which is 98, that's the number here, and that would equal 16. What is the current account balance? Well, that would be equal to 184 minus 165. So again, we're going to be adding this here. So this is going to be 184. This here, the sum of these two numbers is 165. And so the difference is 19. Now, if we look at the capital account balance, the foreign investment in Canada at this exchange rate 0.96 is 150. And then we look at the Canadian investment abroad, which is 158. And we end up with negative $8 or 8 billion. And now it asks, what is the overall balance of payments? So the current and capital account. Well, in this case, the overall balance of payments for both will be equal to 334 minus 323. So 334, minus 323, and that difference is equal to 11. Okay, and so then what is the balance on the official settlements account? Well, it has to be negative 11, and in that case the overall balance of payments will be equal to 0. Now let's look at another exercise. So here we have a figure which shows us the quantity of Canadian dollars on the horizontal axis, and on the vertical axis is the price of Canadian dollars in US dollar. Okay, so this is how many US dollars you would need to buy a Canadian dollar. And so the higher this amount, as this goes up, our currency would be appreciating, because that would suggest you need more US dollars to buy 1 Canadian dollar. So part A, what is the quantity of dollars exchanged given D1 and S1? Well, the answer to that is going to be 60. Okay, what is this quantity worth in US dollars? Well, what's the exchange rate at 60? Well, the exchange rate is actually equal to 0.99. So in order to get that, we just multiply 60 by 0.99. And so that will equal 59.4 billion US. Okay, now it says it says that the demand for the dollar increases by 20. So they're saying that at each price or exchange rate here, the dollar will increase by 20. So that's 2 squares here. So it wants us to draw the new demand curve and label it D2. So to do that, we will just draw a few points to the right of the old demand curve that are 2 boxes over. So we got a point here, point here. I think I'm going to use this instead. So we got a point here, and we'll have a point here, and we'll have a point here. And so the new demand curve will be a line going through these points like that. And so this will be D2, okay? And so it's asking us what the quantity of Canadian dollars exchanged will be if the exchange rate is flexible. So in that case, we know that it will be the intersection of S1 and D1. So it will be 1 and 70. So 70 billion will be the amount that will be exchanged. And that corresponds to this point here. So now suppose instead that the dollar is fixed at its original value. Okay, so if it's fixed at its original value, that would be right here. And so now it's asking, as a result of the change in C, what is the quantity of Canadian dollars exchanged? Well, in this case, the amount would be $80 billion. It's $80 billion because this is the quantity demanded at 0.99. And so if the Bank of Canada wants to keep the exchange rate fixed, it will have to make up for this shortage. So the central bank would have to make this amount available, since only $60 billion would actually be supplied at this exchange rate. Okay? And then what is this quantity worth in US dollars? Well, it would be worth 80 billion times 0.99. So it will be worth 79.2 billion US, which is 80 billion times 0.99. So that concludes the lecture for today. I just wanted to go over the weekly schedule before I stop. So our next class on June 24th, we will have a review class, and then the final exam will be on June 26th. So I'll provide you more information on the final exam in the next class. It will be done in the Slate platform, similar to the midterm. It'll be worth 40%, and I'll let you know a little bit more about that next class. So take care and have a great weekend. Bye for now.